Welcome back. You're with us on Trading Hour. And as promised, we'll get the discussion going on the HDFC-HDFC Bank merger. Remember, the boards are going to be independently meeting, and we're expecting this to take effect sometime in July. Dheeraj Gundlapalle, Senior Research Analyst at Sanford Bernstein, is with us now. Dheeraj, good morning, and thanks so much for joining in. You know, we were discussing this internally even earlier, and our colleague Abhishek was telling us that there are a lot of merger synergies. Obviously, hopefully the merged entity will have lower cost of funds, lower operations, so maybe better margins. I guess the consensus is that we should not see too much pressure on asset quality. ROA, as Abhishek was telling us, should be pretty steady around 2%. But you tell us, when you see this merger from a bird's eye viewpoint, are there any near-term merger risks that investors should be aware of as we get to the event?
Good morning. Thanks for having me on the show. So I think on the mergers front, there are quite a few nitty-gritties around the immediate impact of the merger because it's such a big shift which is happening, and also something which hasn't happened before on this scale. There are always concerns around, let's say, what happens when you merge this large NBFC into a bank. There's an accounting change. There are pricing changes for the mortgage loans. A lot of these things which are still an overhang. But when we look at the numbers and see what these could mean, we don't see any one factor which could be large enough to really cause the bank to slip on their promised ROA of the 1.9 to 2.1% range, right? So yes, there are quite a few unknowns, but none too big to put a risk to the promised 1.9 to 2.1% ROA target for the bank.
Pranav, the other big question is, can HDFC Bank, HDFC Limited, with a size of more than 20 lakh crore, which is going to be double that of ICICI Bank, can it continue to grow on such a large base at the same pace? And if that's, if size is going to become a problem in, for the bank to grow, then does it make sense to look at other private sector financials?
A good question there. So I think we don't see that as a concern, and two reasons really for that. One, going ahead, the real constraint for growth is going to be deposits, right? So assuming it's a universal bank that we're talking about, the constraint is going to be deposits. And in deposits, across markets, what we have seen is that the large deposit bases grow as fast, if not faster than the market. So the idea of a smaller deposit base growing faster has never really worked out, other than in cases like India, where you had a large public sector banks, which were happy market share donors because of various reasons. Otherwise, the large deposit bases have always grown faster. That is one. The second also is that if you look at HDFC in the context of private sector banks, what really happens with the merger is the immense scale difference that comes up, right? So you're talking about HDFC being twice the size of ICICI. And we believe that the next leg of growth, credit growth, will come from the revival in the corporate segment, right? And in that segment, the size of the balance sheet becomes a key differentiator. So sitting with 2x the balance sheet, you have a natural right to win that is far superior to that of any of your smaller peers. So that, again, helps them in terms of growth. Lastly, again, going back to the deposit question, if you look at the way deposit base has been growing for HDFC versus its peers, it's easily been growing at 4 to 5 percentage points faster than its peers. And that's enough to keep the loan growth at the same pace as peers, if not faster.
Pranav, thanks for joining us. So, like you were mentioning, we've seen this outperformance by HDFC Bank versus pretty much all of its peers, right, on deposit gathering. Do you think now with the merged entity, there will be, that continuation continue? I'm talking about the big outperformance that we have seen. Do you think that will also hold going forward? And also, if you could just help us with how you expect some of the other metrics, the NIMs, etc., to really look post this merger.
Right. So I think the 3% outperformance, the 3 percentage points outperformance, I think will continue or would have continued even without the bank doing too much. But then you also have the bank adding aggressively on the branch front and really shifting its own internal focus to deposit gathering. So I expect that gap to actually widen going forward. That is one. And in terms of the metrics near term, I think near term there will be a NIM decline for the merged entity, right? So the 4.1% NIM would probably come off by about 30 to 40 basis points to 3.7 to 3.8. But that will be immediately offset by lower operating costs, right? So the OPEX to assets ratio for HDFC Bank is about 2.1% today and will drop to 1.7% right on the day of the merger. So you have an OPEX ratio which declines and offsets the higher cost of funds. But over time, as the bank gathers more deposits and gets back the deposit ratios to be in line with its pre-merger levels, that cost of funds differential or the drag will decline, whereas the OPEX differential is almost a permanent thing, right? I mean, you're getting that because of scale, and scale is not going to go away. So you will see a scenario where it can generate a sustainably higher ROAs than its peers.
Okay. So Pranav, I'm just looking at your note right now, the latest one that you had. You've got a price target of 2,300 on HDFC Bank with an outperform rating. As the street digests this merger and this behemoth, comes into being, leave us with maybe 2 or 3 key points that investors should monitor. And do you think that even now, is perhaps a good time to get in? And where would you rank HDFC Bank within your, top banking choices?
Okay, so I think in terms of the thesis, why now and why it's still a good time to buy, I think the short-term thesis for HDFC is that the long-term picture will come back to in focus, right? So there's a lot of uncertainty, noise around the merger. All of that should get addressed within a quarter or two post the merger. And then the focus shifts to the long-term story for the bank, which I think is rock solid, right? So you have a scale advantage, which will play out. And therefore, once that comes back to focus, you will see a big re-rating there. So to us, the short-term story as well is just that the long-term story comes back to focus. So that's really the thesis here. And in terms of the pecking order, really we're quite bullish on the large banks in general. We see a strong compounding story for almost all the large private sector banks and even SBI for that matter. And HDFC is right at the top of our rank order simply because beyond the compounding story, there is this re-rating which will happen as the merger-led overhang lifts, right? So I think that's really what puts it right on top of our rank order, followed by the others like Axis, where there is a slow re-rating which could happen as the bank narrows the gap it has built versus its peers, right? So as that operational performance gap narrows, you will see a slow re-rating coming in. And then you have SBI, which I think is a reflection of our positive view on the sector, followed by the view that when corporate comes back, the banks with the larger balance sheets will have a greater right to win, and SBI kind of fits very well into that team. So those would be our top 3 picks in the sector amongst the larger banks.
Pranav, great conversation. Thank you very much for joining in. Look forward to chatting with you far more on CNBC-TV18. Thank you once again for joining in. We'll slip into a break. When we return, we'll come back and discuss market technicals with Ish Thakkar joining in.